Investor population was 20 million in 92, referring to 1990. By 99, a SEBI NCAR study put it at 12 million. By 2008, it is the D. Swarup committee puts it at 8 million. This is the level, it's by millions that people rushed out of the market. And the reason why they went out is because every one of them burnt their fingers, realized it's a mistake, realized that investment is not about giving your money to someone and the broker is going to churn it and give you returns. Although every single went public in that period, every one of them still has big towers. If you look at it from India Bulls towers to India Infoline towers to Motilal Oswal towers, the towers, your money has gone. But the investors have run away from the market. They are not there and they've gone away by the millions. The population is 1/3. This is economic reforms for you over 20 years. Now, you would wonder, maybe you won't because you people are people like us. Okay, we're all together in this. We know what has happened to our money, right? But every time I show these charts to anybody in government, they say, well, it must have gone into mutual funds. So here are the mutual fund numbers. Okay. It's not that people didn't understand markets and that's why they went to mutual funds. They actually tried it. Many people shifted to mutual funds, burned their fingers again and have gone out of the market because this is the kind of fund mobilization. This is the latest number that we're talking about. This is the rate at which people are getting out of mutual funds even today. So then where is the money going? This is a chart that tells you. It is a little dated because the government doesn't come out with figures fast enough. But essentially it shows you a 20-year period where most of the money, the big increase is in bank deposits. And the figure to note, which is important, is that little red sliver that you can see, which has gone smaller. Okay? Just sheer market capitalization, and I showed you that the index is still high. That red portion should have been considerably bigger because every other day we get calls, former colleagues, journalists who call up and say, but you know, Barclays is a great name. I didn't think they would take me for a ride. HSBC is a great name. I didn't think they would. It is not true. And it's only in the financial world. I mean, look at the global financial crisis, whether it's Citibank, whether it's HSBC. Why am I standing here and naming names? Because I don't need to worry. These are people who have paid billions of dollars in fines, or there are large names that have folded up and gone. You don't even talk about them anymore, like Lehman Brothers and others. Starting point, look at these regulators. You look at a scheme that is offered to you, check whether it is properly cleared by the regulator or not. It's a capital market scheme. Is it under SEBI or is it under PFRDA? If it's an insurance scheme, and I say this because there are people who are selling insurance which are unregistered with IRDA. So this is the basic check. And like I said again, no need to feel embarrassed. Last week there was an order about Ocean, and I think most of you would know that Ocean has leading head CEOs of stockbroking companies, CEOs of global consulting companies who had invested.